On behalf of the Counselors of Real Estate, it's a pleasure to welcome you to this session of What's Next for Real Estate in the Life Experience. Office, Truth and Consequences. Thank you for joining us. I'm Bill McCarthy, CRE, Global Chair of the Counselors of Real Estate, and the President of WPJ McCarthy & Company in Burnaby, British Columbia, Canada. The Counselors of Real Estate is a distinguished international group of accomplished advisors solving the world's real estate challenges. Experienced, innovative, credentialed problem solvers. Counselors reside in 21 countries, practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation. I'd like to recognize our What's Next webinar series sponsors, Altus Group, Busak Real Estate, Equus Capital Partners, and WPJ McCarthy & Company. Thank you all for your support. Before we begin, I'm pleased to offer you a free subscription to the Counselor's peer-reviewed professional journal, Real Estate Issues. If you don't already subscribe, please visit cre.org/REI. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcomed, and we'll answer as many questions as time allows. I'm privileged to introduce today's moderator, Kevin Kelly, Executive Managing Director, Cushman Wakefield in New York. Kevin leads a team of data scientists and quantifies the impact of location on key business drivers, primarily the retention and attraction of talent, to inform strategic real estate decisions. He is particularly skilled in geographic information systems and technology. Welcome, Kevin.
Thank you. So thrilled to be here. I'd like to allow the panelists to introduce themselves. And so, Paul, why don't you go first?
Good afternoon, everyone. Paul Chin with Otero Capital. I'm the Chief Investment Officer. And as such, I'm responsible for all investment activities for the firm, as well as all asset management responsibilities. Otero is the real estate lending subsidiary for CDPQ, which is the second largest Canadian pension fund manager in Canada. So we're a balance sheet lender. Otero's AUM, including undrawn commitments, is $29 billion Canadian. And we're active in the US, Canada, and we're starting to explore opportunities in the UK as well as Australia. I've been with Otero now for 14 years, and I've been in commercial mortgage real estate for over 30 years. So I'll stop it at that. Thanks.
Thanks, Paul. Allison, would you like to go next?
Definitely. Thank you, Kevin. And hi, everyone. Thanks for joining. I'm Allison English, Deputy CEO here at Leaseman. Leaseman is the world leader in measuring employee experience in the workplace. Synonymously, or historically, that's been synonymous with the corporate real estate environment. But since the pandemic sent us all home about 3 years ago, we're also measuring what the home environment looks like. So now we're looking at kind of what that hybrid working experience looks like. In addition to that, we've got a global database where we benchmark everything back to, but we also are polling global corporate real estate leaders around the world, and understanding kind of what some of the trends are and what's happening in that environment. So yeah, delighted to talk to you today.
Julie?
Thank you, Kevin, and thanks to everybody for having me here, and hello. Pleased to be here on behalf of CBRE. I run global thought leadership on behalf of CBRE, which basically means that my team and I are putting insights into the market across multiple asset classes, in giving detail around what is driving them, especially from a tenant standpoint, because we know that tenants drive the value in the market, which is why office is such an interesting place right now. And so that's where I have personally been spending most of my time over the last 2.5 to 3 years, which is wholly focused on what this hybrid work world that we are in means for our office footprints of tenants, and therefore what it means for our office market going forward. So that is what I can bring to this discussion today.
Thank you, Julie. So why don't we jump right in? We know that one of the key focuses around real estate today is the impact of remote working, hybrid working. And in honor of the masters, I'm going to try to phrase this question in somewhat of a gambling way. So we track attendance using cell phone data. We think it's an interesting measure. It allows us to say how many employees were in a space in the last 6 weeks compared to a similar 6 weeks pre-pandemic. And when we look at that in an example on Park Avenue in Manhattan, if I looked at the last 6 weeks, it's 80% of what it was pre-pandemic, which is higher than I think most people would expect. If I asked each of you to tell me a year from now, are you going to take the over, meaning the number will be larger, the under, the number gets smaller, it stays roughly the same as we think through where we are at in the progression of return to the office. Be interested to see where you guys shake out. So Julie, why don't you take the lead off?
Well, I am a researcher, so I would start by asking you what tenants are in the building, meaning are they tech or financial services or something different? And also, are there any leases rolling in the building? But I know we can't answer those things. So if I had to blindly make a guess, I would say Manhattan has generally surprised us, I think, to the upside in terms of what I would call the momentum. They certainly were not the first to really drive that return to office. However, they have been the most stable in terms of the momentum that they're building. And I think that the number that you just threw out there is a testament to that. And I think it's because of their diversified industry. It's because of the quality of some of the buildings. I would argue that that building is probably a very high quality, that obviously that is driving that 80% occupancy. And of course, the district that it's in being Manhattan. So because of all those things, I would err to say that we are probably going to be static, if not slightly to the upside this time next year. But I don't think that you're going to be, unless there's a significant rent roll and you have new clients or tenants that are coming in with maybe smaller footprints and therefore more companies in the same building, then I would argue that maybe that 80% could go higher. But as is, I would argue that you're probably a little static to maybe slightly up.
Allison, what do you think? Are we going to see an increase in return, or are we kind of staying static?
I have to agree with pretty much everything Julie said, which probably isn't very interesting for everybody listening because it's much more interesting to have contrarian views. But on this one, I've got to say, I think it's also staying the same. It is significantly higher than a lot of other areas, and a lot of clients we're talking to are struggling to get employees back into those office spaces. We know from our data that hybrid really is the way forward for most companies. And again, for all the reasons Julie said, but looking also at our data, I can't imagine that going up significantly. And I also don't really see it dropping unless, there's something dramatic and specific to that space. So I agree. I'm voting stay the same.
Paul, are you going to have a different, or you are in the static
Not really.
category?
I mean, because you picked a Tuesday, I would say yes, it's more the same to slightly higher. And also because you picked Park Avenue, right, which tends to be, if you had picked third, then it would be a lot different, because it's this concept of flight to quality, and then you would have virtually older, functionally obsolete type buildings. So, and I think the landlords are just adapting to the new norm and making it much more experiential for their employees and their tenants to come in and want to be in. So.
Okay, we got three neutrals. If I took it from 1 year to 3 year, would anyone change their answer?
So again, I go back to who's in the building, right?
Yeah.
And so if you have, and when I say it depends if the leases are rolling, to me, if you have leases that are rolling and you have tenants that we know are downsizing in many cases, which means that the landlord has the ability to get more tenants in that might just have smaller footprints, then I would argue that it will increase, because ideally, especially putting on our sustainability hats, we want buildings that have near full occupancy, at least to where it was before the pandemic, because we know even before the pandemic, it wasn't at 100%. That might be 80% of pandemic, but it might be 60% of where we even were, fully occupied before the pandemic. And so I would like to think that the 3-year view is that you would have right sizing of tenants in that building, which probably means more tenants in that building. And therefore, you're going to get more people in by the nature of that.
Yeah, totally agree. I think at 3 years, the over becomes more reasonable than in a year. So my next question is, we kind of talked about New York. I certainly picked a high side example to start. If we look across some of the different market comparisons that exist in terms of tracking the degree to which people have returned to the office, a lot of indices put New York near the top of the list. And a lot of those indices put markets like San Francisco at the bottom. When you think about the ingredients that may be causing a market like San Francisco, as an example, to lag other markets like in New York, what do you think is driving the fact that that market has seen such a substantial difference in return to office compared to a market like New York? Allison, I'll kick this one over to you first.
One thing that stands out to me that's a massive difference in those two markets is commuting and how people commute. I think we've seen in our clients' data, so there's a module you can add asking questions about the commute, and we've seen that can have a massive impact on not only employees' willingness and desire to return to work, but also just some of the complexity. It can add lots and lots of friction points to that. And I think there's another factor there, which isn't something we're measuring or capturing, but just geographically, that the Bay Area is more spread out. You can find people living in larger accommodation than some of the places in Manhattan and around New York. So I think there are some differences there that also are going to be driving that. But again, looking at the Leasman data and what we know there, I'd say commute's a huge factor.
Paul?
I agree with Alison over in terms of the commute. The other factor is, if you look at San Francisco in general, how they came back out of COVID, they were on lockdowns a lot longer, so that became a little more ingrained. And then also the major industry is tech, which is a little more conducive to working remotely, and the position that most of the big tech companies took in terms of offering up flexibility. I mean, I was there a few months ago, and everyone's starting to try and get their employees back. I think the whole hiring that we have done, I mean, during the pandemic, one company in particular, I think they hired something like 3,000 people that did not live in the Bay Area. So now when they started prepping them, said, listen, we want you back, and we want you to be back in the office here. So that takes a lot of time to organize themselves to try and get back to a city that they were never in, right? So, and a lot of companies also found that they overhired. They didn't have enough physical space to accommodate all their people. So the easy way is just to keep it going a little longer in terms of offering up flexibility until they figure out what their actual needs are. So,
Julie?
And then, the last point is safety. It's the, when cities vacated, a different element basically took over. So, when you walk around areas in San Francisco, I mean, Union Square, when I went in early last year, there was a very strong police presence because they had to make everyone feel safe in those areas, right? So it's a combination of all that.
Yeah, so I would completely agree. And I think that if I had to rank all of those, what is the most important? I think it's the fact that although there is diversity of industry, the reality is there's a lot of tech in San Francisco, and all of our data points to time and time again that tech is different in terms of their approach to a return to office right now. They're much more voluntary with allowing their people to make their own decisions. Despite some of the big names that are out there in the headlines right now, they're not mandating that push into the office too highly. Additionally, we have a recessionary crunch. So now they could, to Paul's point, be looking at release of real estate as a way to save costs. Whether they overcorrect, and come back into the market fiercely when things turn around is a question mark. But I think that all those things are what's really causing San Francisco to have the low occupancy right now.
Yeah, I think those are all absolutely great answers and all contributing. Be interesting to see what happens over the coming months, coming years for that market. So all of you have a very interesting global lens, and I think speaking on behalf of myself, there's a US bias. The rest of the world is back in the office and everything's back to normal. We're the outlier. I was just in London 2 weeks ago, and the finding I had, even in financial services space, is while Tuesday through Thursday were hopping, Monday was light and Friday was a bit of a ghost town. So what I'd love to hear from you all is a little bit about the regional countrywide trends that we're seeing, and what differences we're seeing as it relates to office attendance across the globe. So Paul, you want to go first?
Sure. So overall, I mean, it's so geographic. Let's just start with the US. I mean, more heavily dense with long commutes, living in smaller spaces, everything else. A lot of people have moved out of the core during the pandemic. They got accustomed to certain type of lifestyle, and now to get back into it, where you're coming in, making long commutes, and everything on average is 30% more expensive. So that's one of the deterrents. The areas that did not take strong positions in lockdown, which it was easy to commute in, we saw that their occupancy and usage is much better. Now globally, so let's use Canada again. It's the commute issues. When you see Toronto per se, we're not as back, and also what dominates the downtown. So the financial sector, the big banks, just the logistics of bringing all their people back. And at one point it was about safety, and then some of the banks were also evolving to a hoteling type concept. So it's the logistics around how do they get the people back and make it conducive for teams to work under this environment. Europe's a little different. Their commutes is very efficient in general terms. So we've seen more office usage and everything else. So if you look at from a negativity standpoint, I would rank perception of office as very bearish on US office, and then UK, Europe, it's not been the same experience in Canada. It's this concept of flight to quality and assets as well. So I think when you're layering in sustainability and all of these things, it just makes different markets a little more challenging. So,
Allison, what do you think?
Well, I'm despite my accent, I actually am based in the UK, so I do have firsthand experience with kind of the London market. And I mean, Kevin, you described it really well. My train in the morning on a Monday or a Friday, I generally don't go in on those days, but if I did, it would be empty. Tuesday, Wednesday, Thursday, it gets much more crowded. But I also think in talking to clients that return to office is not a talking point really with any like UK based clients anymore. That was something that it was a big discussion point last year. But here, and I'm thinking most of the rest of the world, the clients we're talking to, with the exception of the US, they've moved on from that as a focal point, and are talking more about what do we do with our office space? How do we maximize that employee experience? They're talking to us, obviously, because that's a big factor for them. But it's less about getting people in the space and more about, okay, what is the space going to be used for? How should we be thinking about that? Like, what is the data telling us to do? Whereas absolutely US clients we're talking to, that is much more of a focal point, and it's more of a pain point. It seems like, because there seems to be perceived or real pressure that like people need to be back, or they need to fill spaces. So those are some of the differences we're experiencing. Just one anecdote, talking to a client fairly recently, they have a once a week guideline. So they said their offices are essentially empty. So their guideline is to try and get people in 1 day a week, which means they average, 7/10, however you can average that out. But, because if you go in 1 day a week and you don't make it that week, then you just go, okay, well, I didn't go. So whatever they're trying to get, people are actually coming in less than that anyway. And they're just accepted it. The real estate guys are just going, this is just how it is. So now we're going to figure out, once we can get out of our leases and out of these spaces, like how we make the right spaces for those people who want to come in and use that space.
So really interesting, Allison. And I would say I came into 2023 saying my goal for myself is not to have to talk about return to office. And boy, was I wrong. I've already failed on that one. But it's your point. Everybody wants to talk still in the US about return to office. And I think that you hit the nail on the head, that it's because there's still a mental stuckness, I think, on wanting things to be the way they were before, just less of the time. And that's very different from what you said in the latter half of your statement, which is really just looking at how work is done and making the workplace the enabler of that, and really therefore driving attendance through the purpose of the office that everybody understands. And I think that we're in the US still stuck in the former, which is we like the way things were before and we want to get back there, just maybe a day, a week less, right? So I don't know when that's going to shift. I always say we're going to be at the future of work when we're not talking about the future of work anymore. So, but I think that that is going to take a number of years. The market that we didn't talk about is Asia, especially Hong Kong, Singapore are two markets that I talk to my team over there a lot about, and everything is just business as usual to them, right? They never really bought into this conversation because the way that COVID was handled and the starts and stops that they had, hybrid became a way of them managing their pandemic period, not something that was permeating through a future culture. And I think that has to do with the pride that people take in the office there, the purpose of the office to them, the household formations that they have in their market. And it's not even, I wouldn't say it's not even still a question. It never was a question to me over there, barring though the Western companies that are over there, right? The multinational companies are the ones that are really dragging down the market because they're tending to make blanket statements across all of their portfolios globally. And that is bringing down the trend, I think, a little in even the Asian markets.
If I could just add one thing to that, I think Standard Chartered Bank, though headquartered in Singapore, is an incredible example of, I mean, they're obviously a big multinational, but incredible example of an organization who very early on in the pandemic said, okay, hybrid's the way forward. How do we make this work for ourselves and for our employees? And so they've come out very publicly with what their plan is. I just saw that their head of HR was saying that 80% of people in the markets that they've enabled hybrid work contracts to go live in, 80% of people have taken them up on it, and so they're doing tons of stuff around that. But they absolutely are the exception for a lot of the reasons you mentioned. I used to live in Hong Kong and in Singapore, and there was working from home would have never worked. There was nowhere to do it, so it's a very good environment.
That's great insight. Allison, I actually want to follow up on something that you were discussing, which is the future of work, right? Which is not necessarily a post-pandemic topic. We've been talking about the future of work for such a long time. If we look back pre-pandemic, which feels like 20 years ago, even though it wasn't quite that long, a lot of organizations were moving towards more activity-based working, more collaborative space. In terms of what we've learned coming through the pandemic, the changes to how people are behaving, what do you see as the future or the biggest trends that will continue to evolve, sort of beyond what we had from the base working that was a trend previously?
Yeah, so one of the things, actually, it's been a kind of one of those mythbusters things we've seen in our data, is when we look at, so within the survey we ask, what activities are important to you in your work and how well are they supported, and we're comparing how well they're supported in an office environment versus the home environment. And actually, the activities related to collaboration for most people are better supported at home than they are in the office. So the initial kind of thought post-COVID or during COVID was, okay, the office, people will go in to collaborate. But what we saw in our data is actually collaboration was working out fairly well at home. So that then has changed. Okay, the offices in the future was going to be for connection, which I think we've done quite a bit of research on this. And there's a publication from last year called Purposeful Presence, which is all about kind of what the purpose of the office is and what people are going to therefore be present for. Kind of to answer your question, though, with the moving forward and the prevalence of hybrid working, and the fact that some people will go into the office and collaborate, but that doesn't mean everyone's going to be there. And not everyone was based in the same office anyway. So what we're seeing with the organizations we're talking to is that they actually now need more cellular spaces and small offices or 1 or 2 person meeting rooms where people can go in and jump on a video call because their colleague, it's a Wednesday and they didn't come in on Wednesday because they were in on Tuesday and they had something to do kind of at home or whatnot. So open plan became the thing. And it worked really well in some cases. It didn't work well in a lot of cases. But now we're seeing the pendulum really swinging the other way and organizations going, okay, open plan can still work and it can still work brilliantly, but people need, as you said, Kevin, with activity-based working, they need that variety of different types of spaces because people can't just go into the office and collaborate 8 hours. And they're probably not going to go in there and do focus work for 8 hours a day. So there's going to have to be the right mix of spaces. And much more than pre-pandemic, there has to be more of that, more spaces for those video conference and the acoustic privacy that comes with that.
That's great. Julie, I have a question for you. So kind of thinking about this, and I know your goal this year wasn't to talk about remote work. This is tangential, but certainly related. If a recent survey was conducted and it found that employees on average would be willing to take an 18% reduction in salary if they were able to be fully remote, and you put your sort of mind your perspective in the mind of a leader of an organization who maybe believes that it's important to drive some of that. How do you rationalize, given the economic environment, the opportunity to maybe curb or slow salary costs against incremental real estate costs, given that dynamic? And what are organizations looking to for data or information to help them drive what's become a critically complicated economic decision?
Yeah, so I think that what you're leading to is this idea that we've just talked about, right? Which is, are we just going to try to have things done the way they were before, just a little differently? Or are we going to really go into our organizations and dissect the way things were done and put it back together in a way that makes sense for the future of work? And I think that if you did that, the latter, which I would argue the minority of organizations are doing today, the very little minority of organizations are doing, because it's hard and it's a transformation, and transformations are always hard and they're rooted in change management, which is a soft, messy subject. If you did that, though, I would argue that every organization has roles that could be done 100% remote, because the argument that a lot of people have about coming to the office are needing to collaborate with others, needing to connect with others. It's a way to get mentored. It's a way to grow your career. There's still a lot of people out there that just want a job. They don't want a career. And we need to actually find those people in the market that want to come back into the workforce, that might not even be in the workforce anymore, which is why our labor force participation rate is so low, and say, here's a job. It can be done remotely. It's very task driven, right? Probably, if it can be done that remotely. And we're willing to pay this for you to do it, which might even vary depending on whatever market you're, answering that call in, right? And so I think that ultimately that's a good, even if you're in great economic times, that's just a good stewardship of company money, right? To say, we're not even going to argue about this question anymore about return to office or not, because we know that we can get cheaper labor in markets and labor pools that maybe we weren't even able to tap before because they weren't available to us, because we tried to get a concentration of labor around. And we're not even going to have to pay for office space for them because it's okay for them to be fully remote. And we're accepting that as that's what it is. So I do think that going down the line, that's what you'll see. Now, the people that really don't believe in this are going to jump to say, well, then that job can just be offshored. And there's an element to that that's true, but I would argue that if you were really tapping into some of these smaller labor pools, where if you only had a requirement of like 20 or 30, you could find some really interesting cheap talent onshore to be able to satisfy that. And I do think that ultimately, as we start dissecting the worlds that we're in, that will rise to the top. Do I think it's the majority of jobs? No, but I do think that there's a cohort.
Totally agree. It's such an interesting exploratory time, and what that looks like in terms of real estate and location strategy, even within those sort of subcomponents, is going to be fascinating. So Paul, in the body of the description for this, and one of the key points was around how real estate values in some estimates have dropped as much as 25%. What assumptions do you think are driving that? How much has to do with our first discussion, which was really around hybrid working, return to office, versus some of the economic factors we have going on in terms of interest rates and some of the complexities we've got going on right now?
So, I mean, interest rates have a huge impact, of course, on real estate values, because it goes to leverage, and then are you getting positive leverage? So a lot of what's driving the values or the deemed values of real estate today is debt service coverage because of the higher interest rates. So what type of coverage you've got? What makes it more complicated on office in particularly, it's saying what is true values today, because it's very, very difficult to ascertain, because in the past you used to be able to do a discounted cash flow on the stability and the future stream of the cash flows coming out of a building. Today, and that would have been, let's say, just use broad-based numbers for certain tenants, you may say, I would assume their lease is rolling in 3 years. I'm going to put a 75% probability they're going to renew their space. The added complexity is now it's deeper diving into what each of the companies do, what do they house there, and what do we think their individual needs are going to be. It may be 75% retention, but how much of their space will they be giving up on it? So that's the unknown, and where it's going. I mean, you look at Toronto, at one point in time, it had one of the lowest vacancy rates in all of North America, and it's just a supply-demand type issue. Now, with some of the tenants giving up space, not sure what their space needs are going to be, we're also seeing some people trying to take shorter term leases, which doesn't really help in terms of your confidence and stability of the cash flows. So it's gotten a lot more complicated, and then you layer in sustainability into it. So older real estate is going to be challenged. So if most of the demand drivers, the tenants, especially if you're publicly traded, they have all these sustainability type targets. So then you want to be in a certain class of property, and that's going to be used to attract and retain talent. So this concept of flight to quality, and we've seen it in everyone's got different classifications, the AA lifestyle, new office buildings, it's highly amenitized. So people want to be there and everything else. So that attraction, and now all of the tenants are getting much, much more specific in terms of what their individual needs and usage. It's not a one size fit all. It used to be pretty simplistic. Now it's gotten much more complex. And, there's all this talk about older office. So what happens to that older space? All this talk about conversions, everything else, it just makes everything much harder. So as a lender or a equity player, it's how much do I have to invest into this property to make it financially feasible or viable? And from a lending perspective, it's how do we get repaid on this loan? And we have to look a little more on the long term. So the immediate is debt service coverage impacting, but then there's this bid ask. It's no one knows. I mean, office is going through a transformation now that retail had gone through, 10 years prior. I mean, who'd have thought retail was the dirty word in the market, where the US in particular was over retailed on a per capita basis. Now they came through COVID surprisingly well and continue to perform well. Now the challenge is office, and whoever had thought that's going to be. So valuations is much more complicated because it's demand drivers too.
So Paul, you touched on a phrase I think we're hearing a lot right now in real estate. We've probably been this way for a while, which is flight to quality. And I think flight to quality means a lot of things to a lot of different people. So I'll throw this one to Julie first. Do you think, that when we say flight to quality, is that the year it was built? Is it the amount of amenities? Is it where it's located? What really is driving the quality designation of a building?
It's a great question. It's one that I've been talking more and more about. And I think it's layered. And I would say at the very foundational layer of quality is the neighborhood that it's in. Paul, I heard you say, I think it was a few questions ago, that you could have a different quality of neighborhood within a 2-block radius. And I think that we are seeing that more and more. And so I would argue that this whole notion of flight to quality is about the building. And if you have a AA building, it's going to do great. Well, I actually think that the commodity space that is in good neighborhoods, better business districts is what we've been calling them, it's going to be absolutely fine, because you're always going to have a tenant that wants to be in a good place at a rock bottom price. And so that's commodity office, because not everybody's a publicly traded company that cares about the bells and whistles of sustainability and technology and every other, trend word that we can say around office. It's just they want a cheap rent and a place for their people to get together in a good place. So I say at the baseline, it is quality of neighborhood, and then it goes from there, in terms of the building. And, does age of building matter? I mean, most of our office stock is pretty old, right? So I would hate to say that age of building matters to a huge degree. I think it's more what kind of capital has been infused in that building over the years and how operational is the landlord. That's, if I were a tenant, what I would be looking at. If I'm not going to go into a building where the landlord is just going to collect a check and not think about what the building needs to do to be kept competitive going forward, I want to be with a landlord who is hungry to make their building marketable in the market that they're in.
Thank you. I mean, we've been sort of touching on office obsolescence throughout this whole discussion. So I want to ask one question about it. There's reports out there where up to 25% of the office space in the US could be obsolete in the next few years. What do we think that does to our major urban centers as a result of that transformation or that finding? And sort of being optimistic, what can we do to turn that into a positive for our cities? So Allison, I'm gonna throw that one to you first.
Well, I think what Julie was saying, I think it'll depend on the location. So I'm not sure that it's the hot areas in the center of a city that are going to be necessarily the problem. I know in some cities that is the problem, when there's kind of that area of the city is relied solely on offices, and there's then kind of the infrastructure around that starts to crumble if there's nothing else, and people all of a sudden stop going in, then the restaurants close, and there's kind of this domino effect. But I think one of the things you need to look at is suburban business parks, and who's in certain places, who's going to be occupying those, right? Like, so I think the problem is not just the cities, it's much more complicated and wider than that. I think within the cities themselves, though, I was talking to someone who was saying they were having an issue in Portland with safety, and the same thing in the actual CBD, but then a mile away, in a different area of the city that was much more mixed use. So there was some residential there was restaurants, and then there was a mix of office spaces. It was buzzing, it was absolutely lively, and it had a totally different feel. So I think areas like that have been thriving, and because again of the mixed use component, I think they have more potential to thrive in future. It's kind of like a lot of other things. If you put all your eggs in one basket, and the basket breaks, then you've kind of got a bit of an issue.
Yeah, I would agree with that. I mean, I think that, yes, is it frightening to say that, whether you believe it or not, up to 25, I don't necessarily believe that much, but that a certain slug of these offices are going to be obsolete faster, or whatever that number might be. But I think that what that means is there's opportunity, and that opportunity is going to knock lightly, and we're going to have to do something with it, because what we know through our research is that younger generations are still wanting to move. Obviously, they move out of student housing, they move out of their parents' basements, and they mostly want to move closer to an urban core. The problem is that the urban core is not affordable for them, and it doesn't have the options that they want. So we're in a bit of a chicken and an egg, because people want to live close to where they work, yet they can't afford to live in the city. So therefore they're not coming into the city because the commute is long, right? So it's like, it's this big circular equation. And I think that if we create more of these districts, and I know this is way easier said than done, but these micro markets within cities that are their own ecosystem where people live and work and play and they're sustainable 7 days a week for the businesses that are in them, that's ultimately the opportunity that we have in front of us. But you're not going to have a private developer alone that's going to arrive at that conclusion. You're going to really need a partnership between them and the municipalities that can help subsidize some of that, that have the vision and the urban plan to do it.
Yeah, Julie, I totally agree. It's the ability to bring down housing costs in some of our biggest, densest, global markets probably creates a talent advantage, which is sort of counterintuitive to where we were 2 or 3 years ago, where it was like, are these cities going to survive? If we can find a way to do that, there's a tremendous opportunity. So, Allison, before you mentioned Mythbusters, I'm going in a slightly different direction, which is if I gave you all the Men in Black eraser machine, and you could erase a general real estate myth that exists out there, which myth would you zap away? So who wants to go first on this one? Paul?
That's a tough one. I don't know. Well, I mean, we're living it right now. So I would say the myth was, because there's a big generation that has seen only in terms of commercial real estate, the belief that values only have one way to go, which is up, and interest rates pretty much only go one way, which is down, which creates value. So, and everything was pretty easy. So I would say that would be one of the greatest myths, because there's a lot of people out there now that are pretty much deer in the headlights under this environment because they've never seen anything like this before, or what it could mean in terms of the higher interest rates. Because if you look at GFC, yeah, it was bad, but for the most part, it wasn't that bad because interest rates were near zero. So, and that can solve a lot of different problems, but and we've seen the knock-on effects now of how quickly and how fast and how high rates had gone up, and the knock-on effects through, SVB amongst others, right? And what does that mean in terms of contagion, possible, all of that? The world's gotten a lot more complicated. So,
Julie, what do you think? What are you zapping?
So I hope I don't take Allison's, because I know we have the same wavelength on a lot of things, but if I could erase anything, it would be this narrative that culture can happen. Culture only can happen in the office. Because I don't believe that at all. And if that's true, then all of the multinational companies out there have a major problem on their hands, because they have global portfolios and global employee bases. And I know that I feel really connected with my colleagues that are overseas, and I feel like we built a culture. So this narrative that culture can only happen in the office, I think, is wrong.
Allison, what do you think?
Mine, but I totally agree. You didn't take it, but yeah, I fully agree. I guess since you started asking the question, this one's been stuck in my head, so I'm going to go with it, even though it's, I think, a little bit less relevant today than it was prior. But open plan offices are always bad. There have been lots of headlines for this over the years, and that's not the case. We've looked at lots of spaces where open plan works really, really, really well. Kevin, your point earlier about activity-based working, there's a lot of different ways to make it work well, but it's not the worst thing ever, and it can work great depending on what people need to use spaces for.
Well, thank you, everybody. We're going to do a few Q&A from the participants, but thank you so much for putting a lot of information in front of us, a lot of stuff to distill. So a few questions. One of them is, what office design and amenities to an office or a building might be possible to attract tenants back to the office? What should we be thinking about in terms of the new office metric?
Allison, you want to take that one? I feel like that's...
Yeah, I've got one thing to say, and then I think Julia had something to add too. I think, one of the things that we know from our research, and it's a really basic one, but it's one of these sentiment super drivers that came out of this statistical research we did several years ago. Tea, coffee, and other refreshments makes a massive difference to people. And it sounds incredibly basic, but think about the hospitality when you have someone in your house. What's the first thing you do? Oh, can I get you something to drink? Would you like a coffee? Something along those lines. People want the same in their office space. I was talking to a client recently, and they said by the time you navigate your way out of the office, get in and out of a series of lifts, get downstairs to the ground floor, and then walk to the nearest cafe and then try and get back up, it's 20 minutes just to go out and buy a cup of coffee. And they didn't have great coffee in the office. So that is a massive friction point, which is relatively easily solvable compared to a lot of the challenges we've been talking about. But give people good coffee.
So I would agree with that. And I'll take it from the viewpoint of a landlord just trying to attract a tenant. And I think that landlords that present themselves as partners to tenants are going to attract the best tenants. And that's a partner in their sustainability goals. If that is a driver for them, it's a partner on their talent retention goals. And it's also a partner in their own footprint efficiency goals by having services and amenities within the building that the tenant themselves don't have to build in, that they can use, even if they have to pay for it, that exist within the landlord's portfolio. So I think that that is something that is a real changer going forward, that landlords need to pay attention to remain competitive.
And a lot of them have started to adapt by going outside of the prototypical real estate professionals. They're going to hospitality, people with hospitality experience to give that programming and everything else for buildings and build out some of the amenities. So
good. Next question would be, if you're a landlord or somebody advising and working with a landlord, are there any changes in basic lease structure or lease renewal strategies that you would recommend to your client or the landlord to try to secure tenancies through this period, be it a lease renewal or a new lease itself?
So I'm happy to start there just because we are just wrapping up a survey where we actually asked this question. And I got really creative with the answers because I was just curious what people, and yes, I mean, is it still the majority are doing what is traditional, pushing for contraction options, really over expansion options, making, trying to reduce lease terms, trying to get increased TIs because all of these people need to put in, a lot of work into their space. All of that traditional stuff is still tried and true. But then there's some interesting new stuff that it's very progressive that some, to your point, Paul, have no idea how to value, but it's things like bundling flexible office space that exists in the building into your lease terms. So through somehow creating a structure where the two are presented together. Even creating a structure where you might have lease space in one building, but you have access to space in that landlord's portfolio of buildings across whatever, portfolio they have. Other things like paying by utilization. And if you recall, there was a really interesting article of a landlord, I believe it was in Brooklyn, that was just trying to get tenants to their building that said, I will not even make you pay above a certain rent until you hit a certain occupancy. And there were quite a few people in the survey that were interested in being able to pay according to their utilization. So I do think that we are going to see some very interesting ways of engaging between landlords and tenants coming up. However, valuing that is going to be a head scratcher, which is going to preclude some of them from doing it. But if you had to ask me, crystal ball, 15 years, where I think we're going to be, I think you're going to see some buildings that are just gigantic neighborhoods and tenants actually join the building. They don't just lease their space. That's where I would predict that we're going because this utilization is so unpredictable.
Anybody else want to weigh in on that one? Okay, we have another question. It's almost on the same line in terms of if you're trying to renew a tenant, is a CPI increase even possible? Should you just be trying to tread water, or should you be thinking that we have to ride a few years of uncertainty and maybe the market comes back more to a traditional landlord market if it does?
That's a Paul question.
I would think it depends. I would think it's dependent on the property, right? If you've got significant holes in your rent roll, then you may want to do that without CPI, because one of your big expenses is carry. So if you can get a triple net lease where they're covering the CAM, then they may want to do it. And it depends on how long they're going for as well. And it's also the credit quality of the tenant. So there's a number of factors that would play out into that. It's not carved in stone that you would build a CPI increase. It's the tenure of the lease, the credit quality, everything else, because it's moot point. If you have a weak tenant, you can build in all the CPI increases. If they don't exist, it doesn't really matter, right?
Okay, another question. It was referenced that some employees might take an 18% decrease in salary. I believe that was the number. Does that then extrapolate into not only a decrease in possible salary, but also benefits if you're working from home? And the extension to that is, should employees sometimes worry about outsourcing not only their job offshore, but those jobs becoming redundant? If it's a matter of working remotely, could somebody retain talent, overseas at the expense of people who have traditionally been working in their communities and previously in an office?
Maybe I'll start. I haven't answered one yet today. So I think the 18%, just from a survey response, was the idea that from a compensation perspective, not necessarily specific to benefits, what would you be willing? I think what we've seen for companies that have tried to capitalize on this differential, it's usually not in the form of a reduction, although that does occur. It's usually to curb some of the wage inflation, which has been extraordinary over the last few years. So it's not necessarily wake up tomorrow, salary's down 18%. I think it's more a mood that people are willing to change their compensation plan, as Julie alluded to before. It's a job, not a career, so that kind of changes the dynamic. So that would be my answer to the first part of that one.
And the only thing that I would say about benefits that I often wonder, and I have more of a question about this, not an answer, but if you are deeming a job remote and you are hiring that person into a remote job, I do wonder how much that opens the company up, and maybe they can sign a contract that says the liability is removed, but just the liability of what happens while that person is working at their home, or what they're responsible for in terms of the ergonomics of their office furniture, how they get IT help, all of that. Are they responsible for paying a portion of heating and cooling bills? And I don't know, I'm sure that there are ways up front to mitigate for that legal teams are all over, but I do think it's going to be a bigger subject if more people get hired into remote direct jobs.
And I think the functionality plays out a big part, because companies have already been doing it, outsourcing to, to cheaper jurisdictions. And they're finding it, when forced to do it, it's working very well. So, and they're not deliberately, laying off individuals. It's just by attrition. As people leave, they're not replacing them. They're replacing them with an outsource. And then the other big factor is the disruptive technology that may play out here, depending on the functionalities, AI. So by its own right, that could play out in a big way too.
Another question. Do you see a trend towards regionalization, regionalism, in terms of setting up, major areas of outsourcing and work at the expense of cities? Are we going into a regional model at the expense of, vibrant city cores, which used to be dominated by the office market? And the extension to that was, here's a simple one. Are there any cities that you think are particularly vulnerable to the trend, and that is, exodusing from the office market?
I'll start this one again and then get everybody jump in. I think that we've kind of gone full circle on this topic. It's from a city perspective, where some of our major urban centers, which we anticipated were going to be most hurt by the pandemic, have been able to come back given that dense urban core. So while we saw, as an example, a number of people leaving New York early in the pandemic to go to places like Florida, the hypothesis being that they're leaving and they're not coming back, they're going to a lower tax state. some of that movement has reversed itself. Florida has still, especially Southern Florida, has seen a huge in-migration from around the country. But I do think that was a little overstated early with people that have returned back to those cities. The factor here is we've talked about it a lot, is commute. Cities with longer commutes are having less attendance, so that opportunity for people to move out. So I think that the cities that are going to be hardest hit are those that have distal or spread out sort of geographies with no urban core, so the commute is longer, therefore making it more difficult for someone to come in and out. But without that mass at the center that provides an opportunity to create a vibrant infrastructure. So I'm not going to pick cities out, but I think that's a limiter of a location like Allison touched on about the Bay Area, which is people live so far away. The infrastructure isn't as substantial to come into the center, which probably limits what that looks like from a long-term viability commutation perspective.
I mean, the fundamentals haven't changed. I mean, I agree with what Julie said before with live, work, play aspect. So does it have to be in a major urban center, or could it be, you look at why some of the suburban offices don't work is because if you have to, every time you want to go out, grab something to eat or anything else, you have to get in your car and go. That doesn't work, right? But for the most part, cities are more efficient. It also depends on the age of infrastructure. We can't build enough highways and roads to accommodate all of this gridlock. That's going to also impact GDP, and productivity, everything else if you're spent commuting. So cities, and you need more densification because of efficiencies. And then there's also the big part that's going to be playing out through the next little while. The ESG factors that, Europe is well ahead of us on. And you look at some of the items, the legislations that are coming through. If you don't meet certain tests, you're basically almost unmarketable, unfinanceable, unsaleable. That's where we're going. So I think people have got to get ahead of the curve, and then they just don't have the capital. That's why they have to, and infrastructure is getting older. So how do you reinvest in it? It goes to the efficiency of it all.
Okay, one last quick question. We're almost out of time, and I'll ask everybody for your quick take on this. Workplace flexibility. If you are an in-demand employee, where does workplace flexibility rank in your top 5 reasons for accepting a position or not? And we'll start with Kevin.
I didn't think I was going first. I would say that based on some of the surveys and responses we've seen, not to caveat it, but it changes a lot by the industry. If you're talking to someone who works in finance, and Julie made this point earlier, I don't think it's going to be as high on the list. There's an expectation. So I think it depend a lot on the function, but consistently having some control where that it's not a mandated 9 to 5, but it doesn't make sense. If that was the ask, I think that's going to be in the top 2 or 3, 3 responses for an individual.
Okay, thank you. Paul?
I agree with Kevin. I think it's going to be higher anyway, because nobody wants to be told what to do, right? And it's impingent upon companies to give people and show that there's value. So it's not, hey, you must do this. It's what is in it for them, and how is it going to help them, whether personally, professionally, whatever it is. How do we create value, right? So we've gone from flexibility to regimented, and just called it hybrid, right? People are saying flexibility, but that's companies responding to say it's not a free-for-all. How do I make it effective that teams can come in? Because if one individual is coming in, he picks one day and the rest of the team are another days, and you're just spending it on remote virtual calls, how is that effective, right? Might as well do it from anywhere else. So
Julie?
So I think the salary is always going to reign supreme. However, I do think that there is a trade-off that people are willing to make, as Kevin alluded to. So I think that flexibility is a close second, and in some cases first. And I believe that it is a way that an employer shows what their culture is going to be like to their employee, which is very important in a competitive talent environment, to recognize that it is 1 or 2, depending on who your person is.
Thank you. Allison?
Yeah, I think it's incredibly important, and I'll just add to that a lack of flexibility can tend to negatively impact people who may have a disability in the workplace and or negatively impacts women. So I think when those blanket policies are come out, then I think you just risk alienating people and having a more homogeneous environment rather than celebrating the diversity that organizations need to thrive. So
Good.
Really good point, Tan.
Well, that concludes our session on truth and consequences. I think everybody would agree it was quite illuminating. So thank you, Kevin, Julie, Allison, and Paul, for your perspective, candor, and most of all, your expertise. I think we all have a better understanding of the truth and consequences and trends shaping the future of the all-important office market. And I'll encourage you all to put your thoughts in writing into our real estate issues journal. I think we need to expand upon this. I'm mostly intrigued by the concept of the corporate culture, not in the corporate office. I think that's something tremendously important going forward. On-demand recordings are available for most of our What's Next seminars, including today's. Please look for announcements on upcoming sessions on the banking crisis in May and highly anticipated return of the Councilor's Economic Advisory Council for a special presentation in June. Until then, on behalf of the Councilors of Real Estate, thank you for attending this session of What's Next for Real Estate and the Life Experience. Thank you all panelists, and thank you everybody for participating. Have a good rest of the day. Goodbye.
Thanks, everyone.
thank you.
Thank you.
Bye.
Thank you.